U.S. debt has been doubling every 10 years. If we're at 37 trillion today, that means by 2034, we're going to be at $100 trillion of debt. What do you think the liquidity is going to be, global liquidity at that point? So yes, I do believe that gold and Bitcoin both have massive legs higher here. But I think that Bitcoin has a higher leg on it because it's in the midst of its early adoption. And as and more people understand it, more and more people adopt it, and more institutions start to adopt it, that's going to just drive that price higher. I think that it gets to $1 million per coin somewhere around 2030, 2032.
James begins by focusing on liquidity, the single most important driver of risk assets. Liquidity refers to the ease with which capital flows through the global economy. When liquidity expands, markets rally. When it contracts, risk assets suffer. Currently, James expects liquidity to contract toward the end of the year. While the United States may still be expanding, other regions are already tightening. This matters because Bitcoin, gold, and equities are all closely tied to liquidity, though with a lag.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I do expect that liquidity will start to contract here at the end of the year globally. The U.S. may be expanding, but you're already seeing it contracting in other areas. So if that happens, then yes. Now, risk assets, things like gold, Bitcoin, stocks, they tend to lag that. Stocks are a little bit closer to it, but Bitcoin and gold will lag it by about 10 or 12 weeks. So you'll see the Bitcoin price, you'll see liquidity expand, and then Bitcoin waits about 10 or 12 weeks and then starts to expand afterwards. The same thing with gold. But gold's gotten a little bit ahead of itself for a few reasons. I do think that we're going to have another drawdown. At the same time, I think that volatility is going to continue to dampen here for Bitcoin because of the institutional interest in it now. Now that you've got these ETFs, the largest growing ETF in history, IBIT, blew away gold's record of gathering assets. It gathered $70 billion in less than a year. So that is indicative of institutional interest. As that interest and knowledge base grows, you're going to have more and more institutional investors. Well, what does that mean? So people want to understand what that means mathematically. Well, why does that dampen volatility? They could still sell it. Of course they could. But if and when Bitcoin becomes a separate asset class that is being allocated to within the portfolio, then what happens is that the institution has a target portfolio allocation, and as Bitcoin goes down, that allocation becomes underweighted to what they want. So they'll buy some in order to top it back up, and as it goes up, they'll sell some to take it off the books because it's gotten too big of a position within the portfolio, and so it's just portfolio rebalancing. And so what will happen is that dampens volatility. So that just means, though, Alex, is that I still believe we're going to have what a so-called crypto winter. Bitcoin is going to draw down. I just don't think it's going to be the 75 to 85% that we've seen before. I think it'll be more like 40 or 50%. I could be proven wrong, but that's what I believe. Unless we have a massive market drawdown and just record-setting turmoil, then I think that's kind of where we're headed with it, and that's going to happen starting at the end of next year, in my opinion. I think the Bitcoin adoption, the way that if you're looking at the rate of adoption of Bitcoin and you would attach the probability of different metrics to it, like the power law and all of that, I think that it gets to $1 million per coin somewhere around 2030, 2032. And so it's not that far off. We're talking about 5 to 7 years. And so, it's almost a 10x from here, which means it'd be almost the size of gold today. So in that time period, though, Alex, I think that the money supply is going to expand significantly too. And that's part of it. So that's not in today's dollars. It's still in tomorrow's dollars. It's assuming the expansion of liquidity supply also. Yeah. Now, if we have an event like we did in 2020, 2021, we come back out with a money bazooka, and that's going to change that calculation. It could go much higher than that. But yeah, I think it's just going to continue to grow in that way. And if you think about it, U.S. debt has been doubling every 10 years. So if we're at 37 trillion today, that means by 2034, we're going to be at $100 trillion of debt. What do you think the liquidity is going to be, global liquidity at that point? So yes, I do believe that gold and Bitcoin both have massive legs higher here. But I think that Bitcoin has a higher leg on it because it's in the midst of its early adoption. And as and more and more people understand it, more and more people adopt it, and more institutions start to adopt it, that's going to just drive that price higher because there's only so much available. And so what you'll see is over the course of the next 10 years, you'll start seeing major companies adopting Bitcoin as part of their treasury strategy. And I'm not talking about the current treasury strategy that we're seeing out there today. I'm not talking about MicroStrategy and some of the other Bitcoin treasury companies. That's a different thing that I'm talking about. Those are specifically designed to arbitrage capital markets to buy more Bitcoin. Different.
You're talking about random companies on the S&P 500.
I'm talking about companies like Apple or Microsoft that say, we need to have 2, 3, 4, 5% of our treasury in Bitcoin, and get it out of some of these longer term bonds that we can't trust because our purchasing power from holding those long term treasuries is just eaten away. It's destroyed. So we don't want to hold any of that. And so, and there will be enough of a risk in U.S. Treasuries at that point that is there. You'll see investors start easing out of that and buying things like Bitcoin and gold. But Bitcoin's so much easier to deal with, and so you'll start seeing that.
Historically, Bitcoin has moved in tandem with the Nasdaq, but that correlation is fading. Bitcoin is starting to trade more in line with global liquidity flows than with tech stocks. That independence is key. As Bitcoin matures, it is becoming its own asset class, one that may soon serve as collateral, treasury backing, and ultimately a foundation for financial stability.
It's been growing since 2009, right? And it has already gathered $2 trillion in its ecosystem. So that protocol has $2 trillion in it right now. That's just mind-boggling if you think about it, right? So gold has been around, and there's this great chart by Jesse Myers. It shows that there's $1 quadrillion worth of assets in the world that are looking for, they're a store of value assets. They're looking for a way to keep value of your hard-earned money. That's not just sitting in the bank. You're actually in. You're doing something with it. Well, out of that 1 quadrillion, which is 1,000 trillion, 129 trillion is still stuck in money, in just money markets and that stuff. But you've got bonds are 318 trillion, real estate's 370 trillion, equities are 135 trillion. You've got art and collectibles, which are about 27 trillion. You've got gold is about 22 trillion, which is a little higher now because it's up a bit from when this chart was made. But gold, listen to what I just said. Gold is about 22 trillion. Gold has been around as a store of value for thousands of years. And it's 22 trillion out of that 1 quadrillion. And Bitcoin is 2 trillion. It's already a tenth the size of gold in just 15 years. That's mind-boggling. And so what you're witnessing is the adoption of a new technology and new store of value. And that's why it's so volatile. Gold had the same volatility when it was being adopted. It's the same thing. And there's nothing, I have nothing against gold. I actually own gold. I'm a believer in it. I'm a believer in hard money. But like I said, Bitcoin's got advantages that gold doesn't have. And so it is taking market share from gold.
Yeah.
But it's primarily been taking market share from equities, that equity bucket as a risk asset. But what's going to happen is it's going to continue to take market share from gold. And it's going to start taking market share from real estate as people realize, man, buying real estate, holding on to it, managing it, paying for the management, paying for the maintenance. Yeah. It's expensive. It's time consuming.
Yeah.
It may be worth it for me to be working on something else while I just invest that extra capital, that excess capital I have in Bitcoin and let it grow and store its value against the money supply instead, or against that liquidity supply instead. Real estate has its other positives. I'm not going to knock on. Of course, it's got tax advantages. It's got income advantages. So, but for those people who are just using it as a store of value, they're going to start realizing Bitcoin's a lot easier to hold as a way to protect yourself against that exceedingly quick expansion of the money supply. So, but all of these will grow too as you see that. So that 1 trillion, that 1 quadrillion become 2 quadrillion. Right. And so that's part of the calculation too. Bitcoin has been the tip of the risk spear for years now. And you typically see when Bitcoin makes a move, then the NASDAQ follows. And it's been it had been correlated. But now if you look at Bitcoin, it's kind of uncorrelated to anything. It's becoming less correlated to anything. It's kind of moving by itself. And it's moving more in tandem with global liquidity than anything else. Again, on a lag. But I do expect that if we have a downturn, when we do have a downturn, that Bitcoin's going to go along with it. It is still considered a risk asset. And so it will drive lower along with it. It depends on how sharp that drawdown is too, and for what reason. If you see a sharp drawdown in all the markets because of some sort of event that's an economic event or a natural disaster or something, then you would see everything go with it, including gold. And the reason for that is that institutional investors sell what they can. So not what they want to, especially when you come in on a Monday morning, there's been a disaster over the weekend, then you walk into your desk and you're like, just take 10 or 20% off. I don't care. Just sell 10 or 20% of the entire portfolio. Let's see where we stand. Yeah. And the reason for that is, again, going back to collateral. Because these investors typically run on margin, and so even if you're a pension fund or an endowment, that this is happening, you do the same thing. You're going to get ahead of it. But the hedge funds and private funds run on leverage, sometimes quite a bit more than Reg T, which is just 50%. But the issue here is that collateral requirement, which is called the haircut, it will move dynamically. And so when you have a drawdown in the markets, you walk in, you used to have to put up maybe 5 or 6 or 7% of a trade for a blue chip stock. Your prime broker saying you got to put up 20% now. And it happens overnight. And so they move the goalposts on you, and it's in your agreements, and it's very difficult to get an agreement that doesn't do that. And so it's called portfolio margining. So they just sell what they can. It's like just get out of it. So that means everything correlates to one. You know this. A lot of your listeners know this. Now, what happens when the Fed then comes in with the Fed put and they start printing money and announce QE? Well, everything starts to go up again. So you get that V-shaped recovery that we saw in 2020.
In April, yeah.
So it's the same exact thing. So, and gold led the way up, and then Bitcoin followed and screamed past gold for years. And so that's one thing.
Still, James reminds us, in times of crisis, correlations go to 1. During sharp market drawdowns, everything sells off, equities, gold, and Bitcoin alike. Why? Because institutions liquidate across the board to meet collateral requirements. But once the Fed steps back in with QE, as it always does, Bitcoin, gold, and risk assets rebound sharply, with Bitcoin typically leading the charge.